Okay, welcome everyone again to the Quant Investing Festival 2021. We are in the third week of our online festival. I'm very happy to see all of you here. Thank you for joining us, especially those who were here early today. I saw that some of you guys came in as early as we started the webinar to let you guys come in at 10:50 a.m. this morning. Thank you for your enthusiasm. I hope that everyone has had a good night's rest on Friday yesterday, because today we are going to go through perhaps one of the biggest highlights of our whole festival, which is on how can we start to run a hedge fund's investment methodology through what we call a multi-strategy portfolio. So in today's session, Patrick from AllQuant will be sharing with us how a multi-strategy portfolio works. And also as part of our CSR efforts, we have also been spending some time providing our Singapore university students with guidance and opportunities to come and learn and suggest how they would integrate quant investing procedures into their own investment portfolio considerations. And so at the end of today, we are going to showcase the fruits and labor of our students from Nanyang Technological University, who are also part of the NTU Investment Interactive Club, right? So we do see a good number of students from NTU coming to join us today, right? It is wonderful that you guys are coming to support each other and learn and improve together, okay? So we are going to hear from our students in a bit, but for a start, right, before we begin, let me just quickly introduce myself, right? I'm Da Wei from iFAST Global Markets. If you still don't know who I am, right? I'm currently in investment advisory for clients running the iFAST platform, and I help to manage the investments entrusted to us to be grown for the many years ahead, right? For this festival, I am glad to be a host and facilitator once again, right? And as mentioned today, we also have our education partners, Ingwan and Patrick from AllQuant joining us, right? Ingwan and Patrick, maybe you guys can introduce yourselves to everyone as well.
Okay, maybe I'll go first. Okay, good day everyone. Welcome back. And for those who actually do not know who I am, my name is Ingwan. All right, and one of the co-founders and the partners in AllQuant. So AllQuant, we are a company that kind of specializes in educating retail investors in a way of quantitative approaches to investing. And these are not your typical value investing, stock selection type of strategies. So we kind of look at and specialize in more non-conventional strategies that are adapted from hedge funds that we used to run ourselves. All right. So, and aside for that, we also work actively with other people within the industry, be it in a way of like promoting quant or educating in quant investing, or like looking out for ways to provide alternative ways of investing options for the everyday investors, right? Just like what we're doing with iFAST Global Markets today. Okay, so before I started AllQuant, right, I spent like about 15 years, more than 15 years now, maybe coming up to 16 years, right, of my career across like asset management, banking, and hedge funds. So I first started off as an investment associate back in GIC, our sovereign wealth fund, and I was part of a team that was responsible for looking and analyzing hedge funds. So we basically conduct investment due diligence on potential hedge funds to decide whether we should allocate the money to them. All right. Then after that, I moved on over to investment bank, basically Credit Suisse and Barclays. And back over there, I did something different from investments. I was more responsible for like valuation control matters pertaining to complex structured products that the banks actually trade with their institutional clients. Okay, and after the banks, I moved on into prop trading for a couple of years. And over there, I was more involved in like short-term type of trading where I was trading interest rate futures, spreads, and some other stuff. And finally, then I moved into a local-based hedge fund called Liquid Value Asset Management, where I was kind of co-managing a fund together with Patrick, who will introduce himself later. So the fund that we actually manage, right, is a multi-strategy fund. And the very approach and principles are also where we adapted, right, for use in AllQuant today for our clients. Okay, so this is a nutshell my background. So Patrick, you want to introduce yourself?
Yeah, sure. Good morning to everyone, and a good day to our more international audience. So for the benefit of those who may not have known me before this, so my name is Patrick, and I'm the co-founder of AllQuant. So before starting AllQuant, I've spent more than 15 years in the industry. So I first started out as a portfolio manager in UBS Private Bank, where I helped to implement discretionary portfolio mandates for private clients. So after spending a couple of years there, an opportunity came up to move to Hong Kong to work for an investment bank. So over there, I covered hedge funds and institutional clients who wanted to trade equity derivative products, such as your options and swaps. Then eventually I came back to Singapore to join Credit Suisse Product Control Department. So my role over there was to review rates and FX structured products that are traded by the bank. So ultimately, I ended up running money in prop trading. And eventually, I became one of the portfolio managers together with Ling in a quantitative hedge fund. Over there, we implemented a multi-strategy portfolio. And so that is something that I will be talking about in today's topic later on. Right, so that's just a quick introduction to my professional background. Okay, I'll speak to you guys shortly. Okay, Dawi, back to you.
Thanks, Ingwan and Patrick. So before we go into the topic today on the multi-strategy portfolio, for those of you who have been attending our previous festival sessions, you would have gone through AllQuant's previous two sharings on volatility and the all-weather strategy, which were intentionally put in place there to help us lay the building blocks for understanding the multi-strategy approach, right? And so for the benefit of those who couldn't join us, and also just as a quick recap, Patrick and Ingwan, could you guys also help us go through briefly what was shared during the sessions on last Saturday and on Tuesday this week as well?
Yeah, sure. So Dawi, can you just pull up the recap slides for volatility? Yeah, okay, thank you. Okay, so it's difficult to summarize a pretty technical topic like volatility into a short recap. So what I've done is I've picked out three main takeaways on this topic. So the first one is that volatility is a measure, right, of how much a security's price can change from one period to another. So over here, we have two securities, right? On the left, we have the utility sector ETF, right, which represents one of the most stable sector in the US. So this is a security that gives a good example of what low volatility looks like. Okay, because its price, right, doesn't really change much over time. So in this case, its price range is around $44 to $54 over a one-year period. So now in contrast, right, if you look on the right, we have Bitcoin, which represents one of the most volatile asset class in recent years. So over the same one-year period, Bitcoin can trade at anywhere between 3,000 to 9,000. Okay, so this is what high volatility looks like. Now, given that Bitcoin can trade over such a wide range in 1 year, we cannot say with much confidence, right, what Bitcoin price will be in 1 year's time, correct? So that's why volatility, right, is also a common measure of risk, because the higher the volatility, right, the greater the uncertainty, or the riskier the underlying security is. Okay, Tawi, next slide. Now, the second takeaway, right, is that volatility can also be traded like an asset. So when used as an asset class, volatility has some very interesting characteristic, okay? First of all, it has very low correlation with the stock market, right? In fact, there is a tendency for volatility to spike whenever the stock market goes down, right? So this makes volatility a very suitable hedging tool to be used in a portfolio. So the chart shown here, right, is just a performance comparison chart going back to 2011. The blue line is a volatility trading strategy that we run in AllQuant, and the dashed red line is the S&P 500. So you can see that both lines go up over time. So what this means is that both are actually making money, so all well and good. But notice how the two lines often move in opposite direction to each other. So when one goes down, the other goes up, and vice versa. Okay, so this is what we want to see if we are looking for diversifying strategies. All right, because if you add them together, what happens is that your portfolio will then have a smoother, slowly rising profile over time. Okay. So in fact, this came in very handy okay, during the peak of the COVID-19 crisis in March last year. So this is the period you see circled in red over here, right? So you can see how the volatility strategy generated huge gains while the S&P 500 crashed. Okay, in fact, this strategy alone single-handedly kept our multi-strategy portfolio afloat during the crisis. Okay, next slide, please, Tawi. Okay, finally, the thing that I want to say is that volatility is a valuable asset class to add to a portfolio, okay, but we need to be aware of the potential pitfalls of trading volatility using two popular exchange-traded products. So if you want to long volatility, okay, you can buy the VXX, but the problem here is that the VXX, right, is designed to lose value over time, okay? On the other hand, if you want to short volatility, you can buy SVXY, and yes, you can expect to make money gradually over time, but the problem is that SVXY can lose almost all its value overnight. Okay, and this is because volatility can spike 100% or more in a single trading day. Okay, so you are caught in a dilemma, right? You either lose money slowly over time, or you risk losing everything overnight. All right, I'm pointing this out not to discourage anyone from trading volatility, but it's really just you need to be aware so that you can size your volatility allocation to your portfolio properly. Okay, so if you do it properly, right, the benefit of trading volatility, in my opinion, outweighs the risk. Okay, especially in the context of a multi-strategy portfolio, as what I have shown in my previous slide. All right, so that's all the three main takeaways that I want to share for my recap. So maybe move on to the next one.
Okay, I believe it's my time for my part of the recap on the all-weather strategy. Let me share my screen. All right, so okay, let me start. So I talked about the all-weather asset allocation strategy back on Monday. Okay, so for those who missed it, this is the recap. So the all-weather strategy is a very practical and sensible strategy. Okay, and I kind of showed a case, right, using a two-asset portfolio comprising of stocks and bonds during that particular webinar itself. Okay, now the traditional ways of how we go about allocating assets have always been what we call the capital-based asset allocation solutions. So these are your 60-40 or your 50-50 portfolios. Okay, so the 60-40 is basically your 60% bond, 60% stocks, 40% bonds, and your 50-50 is the equal weighted portfolio. Okay, so but these solutions, while they are kind of very easy to understand and implement, and that's why they are very popular out there, they are, right, however, right, not the ideal way when it comes to asset allocation, and for various reasons. First, they don't really consider risk, or at least, right, not to the quantitative extent that we're looking at. And second, they are fixed solutions, so they don't adapt to the market. So no matter how the market is going to change, they stay at their 60-40 or their 50-50. Okay, and the last and actually the most important reason is that they are not balanced. Okay, this last thing called balance, right, is the key thing to creating an all-weather portfolio. Now, and why do I say that these traditional portfolios are not balanced? Because if you look at it in terms of capital, right, like a 50-50 portfolio, that means an equal weighted portfolio that's comprising both of stocks and bonds, they do indeed look balanced, right? Because every dollar of stock is matched by a dollar inside the bonds. Okay, so they look balanced from this aspect. But if we were to kind of switch around and start to look at things from the perspective of risk, okay, then what we get instead, right, is a very lopsided picture, right? Because dollar for dollar, the risk within the stocks are a lot higher than those of bonds. So in this case, right, this portfolio is in fact far from balanced because the risk is still largely driven by stocks here. Now, I think most of us would agree with me on this. We cannot predict or control where the market is going, right? And neither can we know like which asset class is going to like perform and which one is going to underperform, right? So if that is the case, then what is the most sensible thing, right, to do when deciding on how much allocation or how much capital you want to allocate to each asset? Now, if you think about it, the answer is very simple. But because you don't know which asset class is going to perform and underperform, then just distribute your risk equally or evenly among all the assets that you have so that they can drive the portfolio equally, right? Then you don't have to worry about which asset is going to perform and which asset is going to underperform, right? So actually what we want here, right, out of a balanced portfolio is not a balance with their capital, but rather a balance in terms of risk, all right? And this kind of allocation methodology is known as risk parity. So with risk parity or the all-weather strategy, there's actually no need to predict the market, like I said earlier on, right? Because now all your assets are driving the portfolio on equal terms, right? And just let the assets go and do their job, right? So in this case, so say in a bull market, right, bonds will lag, but the stocks will do well. But should it come into a bear market, stocks will suffer, but the bonds are going to do well. So they kind of complement, even out each other, right? And another additional beauty of it is that there's, because we are making use of risk to kind of like calculate the parameters and allocate the capital. And risk itself, right, is a dynamic parameter that is derived from the market itself. So at any point in time, it actually reflects what is happening to the markets or the prevalent market conditions. So if you use risk to kind of size your assets allocations will also adapt, right, according to the different market conditions that happen. Okay, and that illustrates adaptiveness of the risk parity strategy using this slide here. So basically the bar chart on the left shows you the allocation across stocks and bonds in the portfolio constructed using the risk parity approach. So the portfolio is rebalanced every month according to the prevailing market risk conditions. And the chart on the right shows you the net asset value of the different portfolios. So the green line actually represents your risk parity portfolio. And you can see from here that month on month, the asset allocations actually changes over time. So when the markets get more volatile, the stock markets get more volatile, so the risk of stocks is going to rise up. Then we're going to allocate less, right, to stocks and more to bonds. And when the market gets calmer and more stable, it starts to increase its allocations back to stocks relative to the bonds again. And when it gets very volatile again, right, towards the end of the year, right, then it reduces its allocation dramatically. So this is for the year 2018. So I picked 2018 because it is a turbulent year so that you can see the changes in the asset allocations more clearly over here. But the thing I want to point out is that if you look at the net asset value chart at the end, well, so this year was a particularly bad year for stocks in general, right? So you see where the stocks went, it went all the way down here. Okay, it was also a very average and mediocre year for bonds. But the risk parity portfolio actually managed to outperform both of them and end the year slightly up. So that is because of this dynamic adaptiveness or the risk weighting methodology that's being used here, right? If not, your risk parity portfolio is never going to outperform these two underlying assets. Okay, so a good example would be if you look at this dotted line here, which represents a 50-50 portfolio or the equal weighted portfolio of stocks and bonds. It actually underperformed bonds, right? So it's somewhere in between. So this proves to you the usefulness of adaptiveness or using the risk to size up your allocation itself. Okay. Now this risk parity portfolio as well as a vol trading strategy that Patrick talked about earlier are just two of the strategies that we run. There are actually more that you can do. So you can actually also combine these two strategies with other strategies to kind of complement each other, right? And that in turn will help you make the portfolio even more resilient and have a much better risk reward over the long term. So I showed before in an earlier webinar. So this is the modeled performance of our multi-strategy portfolio. And I'm showing here again to get the point across. So this multi-strategy portfolio comprised of 4 different strategies that are diversified across like different asset classes, different markets, and different regions. All right. And what do I mean when I say it is resilient and stable? You just need to take a look at the performance statistics. So it delivers about 11.4% return per year by itself, which is already higher than what the stock markets can give you. So 8% is the global stock markets and 7.5% is our local Singapore stock markets. Okay. And what is more notable, remarkable is the risk level taken, right, to achieve this set of performance. So the vol or the risk of this multi-strategy portfolio is significantly lower at 8.8% compared with 15.5% for global stocks and like almost 22% for the Singapore stock markets. And if you were to look at the net asset value, right, which is represented by the blue line here on the growth of the multi-strategy portfolio, well, you can see that it's fairly stable, right? It don't fluctuate as much as how the stock markets move. And if you were to zoom in on this 4 circled periods, which represents tough periods experienced by the stock markets, which include your great financial crisis, which is here, as well as the COVID-19 pandemic last year in 2020, the multi-strategy portfolio actually did fairly well, right, across all this period itself. And if you were to zoom in to each of these individual periods here, right, we can see that in almost all of them, the multi-strategy portfolio is either almost flat or even positive, right, while the stock markets actually sustain a heavy loss. So this is only possible through diversification that is carefully calibrated across like different strategies and different asset classes. So when one strategy or asset class is down, you may have others, right, within your portfolio that can be doing well. All right, so the concept is very simple, okay? And now for information, you can actually implement this multi-strategy portfolio with the help of iFAST Global Markets. So we have currently a working arrangement with this, with them on this. And right after this, I think Dao will be sharing more details with you on the service. And subsequently, I think Patrick will also be shedding a little bit more light on the multi-strategy approach later. Okay, so that's all I have for this recap. Back to you, Dao.
Hi, yes, and thanks Ingwan and Patrick for that sharing. And just to share as well on the arrangement that AllQuant has with us to allow retail investors like you and I to run the hedge fund strategy, but we do have a convenient way to assist you in carrying out the trades needed to run one of their multi-strategy portfolios, right? And how it is done is that AllQuant has graciously been sharing with us on their exact ETF allocations in their portfolios that you should have at any point in time, right? And which we can all see over here, right? Please do not take these allocations and try to implement them on their own, as this information, it is already a few months outdated. And it also does not reflect the current volatility ETF positions that we are having, right? Nevertheless, this is to let everyone understand that we are here to provide that convenience for you if you do choose to run AllQuant strategy, as the ETF trades, they are derived for you, right? And all you have to do is to actually just give your email approval for every trade that would happen about 1 to 2 times a month. Okay. So some of you guys in our previous sessions, you have asked if this has been running with real investors' money, right? The answer is yes, it is, and it has been running with real money, but the returns from which Ingwan has shared just now to be close to their very stable model performance of 11% per annum, right? And we would love to show everyone actually examples of real portfolios run with investors' real money, but due to confidentiality and some compliance mandates, we can't do it over here, right? But nevertheless, for those of us who have been working for a while, or you would simply just like to consider giving this a go, right? You can click the URL that I think Ingwan, you put it in the chat box. Yes, I see in the chat box. Yes. So for those of you who are going to consider giving this a go, right? Feel free to just click that URL that Ingwan has shared, right? So that we can link up and explore with you whether this strategy would be suitable for you. Okay. And so without further ado, let's proceed on as well to the next section for what we have on the agenda today. Right, Patrick is going to share with us more details on what the multi-strategy approach is about. Okay, so let me hand the time over to Patrick. And Patrick, please feel free to take over.
Yep. Okay, just let me pull up my my screen first. All right, I believe everybody can see my screen now. So, so let me start. So today's topic, right, is at the heart of everything we do at AllQuant. So Ingwan and I, we set out to answer a very simple question, right? And the question is, how can we build an investment portfolio that is resilient in all kinds of market conditions, be it bull or bear market, inflationary or deflationary? Now, when we say resilient, right, we do not simply want to lose less than the market when the markets are down. What we want is really for the portfolio to be able to generate positive returns consistently, maybe not every month, but every year. right? And the answer that came back to us was the multi-strategy portfolio. And that is what I will be talking about in this session. Now, in the earlier sessions, Ing-Wan briefly introduced 4 quantitative strategies that we run at AllQuant, and we already covered 2 of these strategies in detail, okay, namely the volatility risk premium strategy and the risk parity strategy. So today, I'm going to show you the advantages of running all these strategies together in a single multi-strategy portfolio. Now, but before I start, let me use a more common analogy, right, to illustrate why the multi-strategy approach is sensible. So imagine, right, you're tasked by your country to send a team of athletes to represent your country in the Olympic Games. Your objective is to bring back as many medals as possible. So would you be sending only the fastest sprinters in your country to take part in all the events? Or would you actually be carefully selecting athletes based on the event that the athlete is expected to compete in? So I believe all of you would agree that the second approach is the more sensible one, correct? So it is exactly the same in capital markets, right? There are different market conditions, which is the equivalent of the different events in the Olympic. So what you want to do is you want to populate your portfolio with different strategies that will do well under the different market conditions. So in this way, we are more confident that no matter what the market does, right, there will be strategies that are so-called winning medals for us. Okay, I hope this makes sense for everyone. Okay, so now we can move on. Now take a look at these 2 investment portfolios. Okay, they both started at the same time in 2011, and both ended with the same value at the end of 2020. However, Portfolio A had a very smooth growth throughout the journey, while Portfolio B had quite a bumpy ride with many significant drawdowns along the way. Now, I'm sure all of you would prefer to have your money in Portfolio A rather than Portfolio B, correct? Of course, it is also important to know the underlying types of strategies being run in the portfolio. But assuming the quality checks are all done and the types of strategies run in Portfolio A passes all the quality checks, then I think it is safe to say that Portfolio A is the winner here, right? So how can one create an investment portfolio that is more like Portfolio A? Well, actually, there is an answer, and that is we can make use of the only free lunch available in finance, and that is called diversification. Now, some people might scoff at diversification and say that it is only a recipe for getting mediocre investment returns. Okay, but have you ever wondered, right? It could be because these guys have not really been doing it right all along. Okay, there are actually 3 different levels of diversification. And as we go up the levels, right, we can reap more benefits. Okay, so the different levels have to do with the types of assets that we actually put into our portfolio. So at the very basic level, right, is a portfolio that holds only stocks. So if the stocks are spread across different industries and sectors, then when one sector is hit, only stocks that are exposed to that sector will be affected. So I'll give an example. A technology company, right, is quite different from a utilities company. So if a specific event that hits the tech sector, right, we can expect that the tech sector, or rather the tech company, will go down. Okay, but the utilities company should be relatively okay. It may still go down, right, but not as badly as the tech company. But the problem is that stocks all belong to the asset class known as equities, and they are all exposed to equity risk. So when there is a broad equity market sell-off, you can be sure that all stocks would also be hit. Therefore, this basic level of diversification is unable to protect the portfolio in an economic recession. All right? So the second level of diversification is to diversify across asset classes like your bonds, commodities, and other types of asset classes. So this is where modern portfolio theory comes in. Okay, I will talk about this modern portfolio theory shortly, but for now, just know that there are assets that can do well in environments that are harsh for stocks. So if we include some of these assets into the portfolio, these assets would help to keep the portfolio afloat when your stocks go down. Okay, so this is also the level of diversification for the all-weather strategy that Ing-Wan has shared in an earlier session. Okay, so diversifying across asset classes is an improvement, right, from holding a pure stocks portfolio. But then it also has its limitations. Okay, firstly, there are not that many asset classes that are truly non-correlated to stocks. All right. And secondly, in the event of a crisis, a liquidity squeeze can happen and all your asset classes can also go down together. Okay, even though it might be a temporary thing, but they'll all still go down together. So that is what we have seen time and again, right, in past crises. But what if we can create our own asset classes that have very low correlation to one another, and some of these asset class, right, can even benefit during a liquidity squeeze? Okay, this is where we come to the ultimate level of diversifying across strategies. Right, this is the domain of hedge funds. And it is in the very nature of hedge funds to aim to be non-correlated to equity markets. Since the first hedge fund was created in 1949, right, this niche industry have been creating various types of strategies that can be quite different from one another. So if we treat these strategies as an extension of asset classes and we add them to our portfolio, right, we would then have the best chance, all right, of having a resilient portfolio that most resemble the portfolio A that we have seen earlier. Okay, so this represents the ultimate free lunch, all right? So let's take a closer look at asset class diversification by introducing modern portfolio theory. If we have a historical period of price data for a broad index of stocks and bonds, we can calculate the annualized return and annualized volatility for both asset class over this period. And generally, the numbers would look something like what is presented here. Right? Stocks are expected to give a higher return than bonds, right? But at the same time, stocks are expected to be a lot more volatile than bonds. Okay, this all should make a lot of sense to all of you, right? So the Sharpe ratio is nothing but the simple annualized return, right, divided by the annualized volatility. So another name for the Sharpe ratio is the risk-adjusted return, and it is called that way because it tells you how much return is generated on a unit of volatility, which can be seen as risk. So an interesting observation here, right, is that bonds can actually give a better risk-adjusted return than your stocks. In this case, bonds can give you almost 2 times more return per unit of risk taken. Okay, next, if we have a chart, right, with annualized return on the y-axis and then annualized volatility on the x-axis, we can plot where a portfolio lies on this chart based on the composition of the portfolio. So a 100% stock portfolio will be at the top right corner of the chart as shown here. Okay, high risk, high return, nothing really amazing here, right? And then on the other hand, we have a 100% bond portfolio that will be somewhere near the bottom left of the chart. Low risk, low return. Again, nothing new here, right? So it should all make sense so far, correct? Now, where it starts to get interesting is when we mix stocks and bonds in the portfolio. Okay, we can calculate the return and volatility for portfolios with various allocations of stocks and bonds, and we can draw a line that goes through all the points as shown here, right? So this line that you get is known as the efficient frontier, and all possible combination of a 2-asset portfolio would sit on this line. Okay, so for example, the 60-40 portfolio, which is a favorite allocation in finance, sits somewhere in the middle. And then there is a minimum variance portfolio, right, that gives the lowest possible volatility. So an interesting observation here is that adding some risky asset actually allows you to have even lesser risk in your portfolio than holding 100% of the least risky asset, which in this example is bonds. Okay, however, the minimum variance portfolio, right, is still not the most efficient in terms of delivering the highest Sharpe ratio. So to arrive at the most efficient portfolio, right, what we need is to draw a line starting from the origin of the plot, and then you connect it to run tangent to the efficient frontier. Okay, so the point at which this line meets the efficient frontier will then give you the portfolio combination that gives the highest risk-adjusted return. Now, in case you're wondering why this is the case, so the slope of the red line, right, is nothing but the portfolio annualized return divided by your portfolio annualized volatility. And this is the formula for Sharpe ratio. Okay, so the steeper the slope, the higher the Sharpe ratio. Okay, and the steeper slope, right, is when the red line runs tangent to this efficient frontier. Okay, so there's another name for this efficient frontier. It is also called the super efficient portfolio, right? So this is basically the modern portfolio theory in a nutshell. Okay. Now, this is the same performance statistics we have seen in the previous slide for stocks and bonds. What if we are able to design a strategy that gives similar levels of return as stocks, okay, but comes with lower volatility compared to your stocks? We will then have a stock plus asset class that gives a better risk-adjusted return, in this case of 0.75, compared to only 0.46 for bonds. For stocks, right? At the same time, what if we are also able to design a strategy that has similar risk as bonds, but this time it is able to generate a higher return than bonds? We will then have a bond plus asset class that gives a better risk-adjusted return of 1.2 in this case, compared to 0.8 for bonds. All right. By the way, these are two real strategies that we have developed at AllQuant. Okay, the stock plus strategy is our trend following strategy, and the bond plus strategy is our all-weather or risk parity strategy. Okay. So if we populate the portfolio with these two strategies instead of stocks and bonds, what we get is an efficient frontier, as shown by the orange line here. So what we have really done, right, is that we have actually pushed out the efficient frontier and arrived at a more efficient portfolio than what was previously possible, right, with only asset class diversification. Okay, this is obviously a simplified version of only using two underlying assets or strategies to build your portfolio, right? But the picture is the same when you use multiple assets or strategies. Okay, so this illustrates the benefits of diversifying using well-crafted strategies. Okay. So the important thing about adding strategies to a portfolio, right, is to make sure that each strategy that you add has low correlation with the rest of the strategies that already exist in your portfolio. Okay, this should all make sense intuitively, because if the strategy you're adding is highly correlated with a strategy that you already have, right, then you might as well just increase the allocation to that original strategy in the first place, correct? So a correlation matrix, right, is a very useful tool to let you see at one glance the correlation among all the strategies in your portfolio. Okay, so this is an example of the correlation matrix of the 4 quantitative strategies that we have. Let me just highlight a few correlations so that you know how to interpret this matrix. Okay, the diagonal line that you see here, okay, is actually showing a number of 1. And this is because this is actually a correlation of the strategy onto itself. Okay, so for example, here you have risk parity correlating to itself. And then here you have trend correlating to itself as well. Okay, so this diagonal line, right, you can see it as a mirror. Okay, so any correlation on each side of the mirror, right, would be reflected on the other side. All right, so over here, you can see that the trend strategy has a correlation with risk parity of 0.43. Okay, and then so it is also reflected on the mirror over here, right, 0.43. Okay, so you can see that the correlation in general, right, is pretty low among all the strategies. Okay, but what I want to highlight is that it's especially low for our volatility strategy. Okay, you can almost say that the volatility strategy, right, is non-correlated to any of the other strategies. Okay. So let's see how the multi-strategy portfolio performed in the real world using last year, which includes the period in March when COVID-19, right, first spread across the world, triggering a global panic. Okay, so the S&P 500 lost 34% within a month, but the multi-strategy portfolio held up well. Okay, so this was mainly due to the volatility strategy, which single-handedly made up for the losses experienced by some of the other strategies. Okay, but subsequently, when S&P 500 recovered, right, the roles reversed. And the strategies that lost during the crash started to recover. And the volatility strategy, right, now starts to give back some of the gains made during the crash. Okay, but overall, the multi-strategy continued to move up, although not as fast as the S&P 500. But for the full year, the multi-strategy portfolio made 22%, which still outperformed the S&P 500 for the whole year. Okay, but the more important point, right, is that it didn't have to go through the roller coaster ride, unlike the S&P 500. Okay, so this is an example of how a multi-strategy approach, right, can be resilient during a harsh market condition. All right. So this is a longer term performance of our multi-strategy portfolio going all the way back to 2011, as represented by the solid blue line. The dashed lines, right, are actually the performance of the individual strategies. So you can see how they move quite independently of one another. There are periods when they actually move in opposite directions. So as I mentioned earlier, right, this is exactly what you want to see because that is what diversification is about, right? It is because of the different strategies dancing to their own tune at different times that we're able to get the stable blue line for the overall portfolio. Okay, so now if this blue line looks familiar to you, right, it is because this blue line is actually the stable portfolio A that we have seen earlier. Okay. Okay, well, so we have come to the end of today's presentation. Now, the multi-strategy approach, right, that I've shared today, like Ingwan mentioned earlier, can be implemented by individual investors through the use of publicly traded ETFs available in the market. So in fact, Dawei have already been implementing it for some of its clients through the iFAST Global Markets platform. So if you're also interested in getting Dawei to help you, okay, you can scan this QR code. It will bring you to our website. You just need to fill in a simple form and Dawei will be in touch to get the conversation started. Or if you want to reach out to Ingwan and myself, you can also contact us separately. Our contact details are also found in the website. Okay, so for now, I'll hand over to Dawei to administer the lucky draw quiz questions. There will just be 2 simple multiple choice questions related to today's topic. You should be able to finish each question in less than a minute. But in the meantime, if you have any questions related to today's topic, feel free to type them in the Q&A box. Okay, we have already seen some related questions coming in today. So we will answer these questions after the quiz, all right? So good luck, and I'll talk to you in a short while. Dawei, back to you.
Okay, thanks, Patrick, for that wonderful sharing. I think it is so powerful and so important for us to realize actually what the modern portfolio theory is about, right? So for those of you who might not be familiar, right, the modern portfolio theory, it is actually one of the very, very key and very important outcomes that came out from the whole study of economics and investments. And it was done up by Harry Markowitz. He was an economist. And this theory eventually became a Nobel Prize winner in 1990. And why do I say that it's very important? Why? It is because through this modern portfolio theory, a lot of the funds that are run in the investment world today, the reason why we can see the outperformance over the rest of the general stock market indices, a lot of it is due to this modern portfolio theory. And this is why we find it so important to share with everyone here today on what MPT is and how you can actually utilize it in your multi-strategy portfolio. Okay, so from here, let's go straight into the quiz, right? As I mentioned before, that the quiz, it is run in tandem together with our lucky draw. So for every correct answer that we have in any of our quizzes for this series of webinars in our Quant Investing Festival, every correct answer is going to give you a higher and higher chance to win our lucky draw, where we are giving out CapitaLand vouchers as well as AllQuant's mega intermediate and starter course packages, right? And for those of you who have asked on how do you really trade volatility, when do you go in and out, right? The answer is found inside the AllQuant mega course package itself. Okay, so if you are our winner, we'll be very happy for you because you will be able to know clearly, right, how do you really run that trading volatility strategy by itself. Okay, so let me bring up the quiz now. Okay. So please bring up your mobile phones and you are able to join the quiz through scanning this QR code. Or alternatively, you can look at the link, the URL at the top of the screen, where you can go to your browser on your phone and key in ahaslides.com, right, /Z1FQG. Okay, let's have some time to let everyone come in. Thank you for all the likes, right? The hearts, the happy faces. And I know some of y'all are pressing the sad face just for fun. Right? I know it's quite nice to press. But please press more of the likes and the hearts, please. Thank you. Okay, so I'm going to remove the QR code, right? So for those of you who are still trying to join, the link will still be at the top of the screen, right? Just go to ahaslides.com and type in Z1FQG at the back. Okay. So as mentioned, there are 2 MCQ questions for every quiz session, right? And for each question, we have 60 seconds to answer them. Okay. And let's get ready to enter, right? To let us be able to identify you in case you win our lucky draw, please provide the last 4 characters of your NRIC and passport number if you are not from Singapore, right? And your name plus your email address as well. Okay, we are going to start soon, right? So please press join on your mobile phone. Make sure that you press join, don't forget to come in. Right, for those of us who have not managed to enter the quiz, you can still do so, right? The quiz won't close on you. You can still join through the link at the top of the screen. Okay, we're going to start. Let's go. Right, the first question. What is the only free lunch in investing? That's a very simple question. Is it that markets can only go up, so we will all profit because the markets can only go up in the long run? Right? Or is it diversification? Is it that we can just open any investment account, right? Or we can use our investing profits to get a good buffet life? I think that's a very interesting idea. But we want to keep this quiz very simple and very easy for all of you so that everyone has a good chance to enter and participate in our lucky draw. Okay, so 20 seconds remaining. Please remember to press submit on your answer. 10 seconds left. Okay, let's see what is the answer. Right. Is everyone done? Okay. Okay, great. So everyone did well, right? We have the answer. It is diversification, right? Really, in the investment world, there is no other free lunch other than diversification by itself. And I have mentioned this a number of times previously throughout the festival, the series of webinars that we have, that for every investor, the first and very, very important thing for all of us to appreciate is diversification itself. Okay, so let's go on to the next question. Which of the following would most likely result in the highest risk-adjusted return for a portfolio? Okay, so the highest risk-adjusted return, it would also mean the highest Sharpe ratio or the best risk to return ratio. Okay. So many times we try to use stocks, and we do see that many stocks are highly correlated. We also see many industries, many assets, they are very highly correlated. strategies, they can be very highly correlated as well. So we need to be careful on which strategies we are implementing for our portfolio. Okay, so final few seconds. Everyone has answered yes, right? So the answer is to choose low correlated strategies. Right? Many a times when we try to do diversification, we are only diversifying across different company stocks, or we are trying to diversify across different asset classes, trying to put bonds in, trying to put gold in, real estate in, agriculture, technology, many different asset classes in, right? But what we find at the end of the day is that still these are very highly correlated with each other. And when the market falls, we do not have a way of hedging, right? So the way to go about hedging and protecting our portfolio is to have that different strategies and the low correlation among our strategies. Okay, so thank you for participating, right? That's all for the quiz. If you are the winner of our festival, we will be announcing you, the listener for our lucky draw. We will be announcing you as the winner on the 2nd of October, which is the last day of our festival. Okay, so for now, let's proceed on. It is now time for us to come and look at currently our students' challenge, right? So today we have our students from NTU with us, right? But then just let me bring up the screen over here. Okay, so now for the next 10 minutes or so, we are going into our students' challenge, right? And we are going to showcase the work of our students from Nanyang Technological University, right? During which, for the retail investors here with us today, as well as the general members of the public, if you have any questions on the multi-strategy portfolio, right, or just on anything related to quant investing, please feel free to use the time and type your questions into the Zoom Q&A section, and we will try to answer as many of them as we can by the end of today's session. Okay. So I do need to allow, I think Junwei is here, right? So hold on so that I can let Junwei come in and join us. Junwei from NTU. Okay, Junwei, I think you should be able to turn on your video by now. So anyway, just to, yes.
I'm not able to turn on video.
Okay, let me just apologies for a little bit of a technical issue. Okay, you should be able to do it by now. Okay, thanks. And just to share with everyone that our students from NTU, they were originally going to do a live presentation for us today, but also because of how the exams are just around the corner and how they would have their various other heavy commitments in pursuing their degree, which I'm sure all of us can definitely relate and understand. Right? They have actually worked doubly hard to film and record their work so that we can still see their team's effort today. Right? And although a few of their members, their team members, they are not able to be here together with us today, but nevertheless, we still have with us Junwei and also Junwei to be here to maybe introduce yourselves, right? Share with us, what you guys have been doing in your CCA, right? Introduce maybe your team, and also please share with us what the Nanyang Student Investment Fund is about. Hey, Junwei, you want to, yes, please unmute yourself, right, so that we can all hear you.
Yep, thanks, Dawei. So happy Saturday, everyone. So we're happy to see so many enthusiastic participants coming down today for this Quant Festival. So my name is Junwei, and I'm the VP of RIC, or the Research and Education arm for RIC. So within our RIC, Research and Education, we have also this Nanyang Student Investment Fund. So what we do is actually a buy-side equity report or equity research. So we specialize in stock picking and pitching. So very grateful for this opportunity to actually come down and join this festival. And throughout this few weeks, I actually learned quite a lot from about quantitative investing. So unfortunately, some of my directors are not able to join us today due to lesson commitments as well as exam preparation. So together with me is Jun, who is one of my very capable director. And I think without further ado, let's play the video and show what we have prepared for the audience today.
Thank you, Junwei, and thank you, Junwei, as well for being here with us. So let's now take a look at what our gentleman here has in store for us in suggesting how an investment portfolio can be run today. Do note that the information shared here is purely meant for education purposes only through our students, and it does not constitute the views of iFAST nor AllQuant. Let me bring up what you guys have.
Hello everyone. First and foremost, we would like to thank AllQuant and iFAST for organizing all of the lessons over the past 3 weeks. We are from Nanyang Student Investment Fund, and today we'll be presenting on how we constructed our all-weather resilient portfolio. To start out with our strategic asset allocation, or SAA for short, we constructed 2 basic types of portfolios. The traditional portfolio containing only equities, bonds, and gold, while the modern portfolio consists of equities, bonds, and alternatives, which contain more than just gold. Over here, right off the bat, that we can see that including different types of alternative asset classes, such as core infrastructure, core transport, and real estate can help to boost expected returns from 6% to 6.7%, while keeping risk relatively constant at 8.3% to 8.4%. The superiority of the modern portfolio can be seen based on its superior Sharpe ratio, which measures the amount of return you receive for holding an additional unit of risk. Now, how do we derive this 2 portfolio? Is that we obtain the risk and return and the correlation assumption for the different asset classes from JP Morgan's LTCMA. We then ran it through an Excel solver to obtain the optimal portfolio result for each equity, fixed income, alternatives allocation via a mean variance optimization. We then chose the portfolio allocation with the higher Sharpe ratio to be the optimal portfolio, and thus arrived to a 2 portfolio that you see on the screen. While deriving the 2 portfolios, we also set 2 restrictions. We don't want more than 20% exposure to any single asset class to ensure diversification of our portfolio, and we set a fixed 3% cash for liquidity needs.
So before we move on to our tactical asset allocation, or TAA for short, we did a little research on the current state of the world. 2020 was the year of the pandemic, and humankind's virus has been the preoccupation of the globe. Although we see that most countries have rolled out their vaccination program, some are more successful than others. Resurgence in the recent months threatened to derail the economic recovery. We believe that developed countries are expected to be fully vaccinated by the late 2021 to mid-2022, and that less developed countries are unlikely to be fully vaccinated till beyond 2022. With regards to the global recovery, money flows to where growth is. Back in 2020, when most countries suffered a decline in GDP, China is the only economy to achieve a GDP growth of more than 2% in 2020. While the recent regulation clampdown has put a dent in investors' confidence towards China's economy, we cannot deny that China's economy still has a lot of room for growth. We believe that once the clampdowns settle down, China's economy would experience a strong recovery back to pre-COVID levels. Therefore, we believe that Chinese and EM equities are attractive in the short term on stronger economic recovery around the world. As the safe haven effect wanes and sentiment worldwide improve, investors would sell their USD assets in search for higher yielding, riskier assets in other regions. We propose to overweight on Chinese and EM and international equities and underweight on US equities.
Yields worldwide are below that of 10-year averages and are trending towards their mean as inflation expectation rises. We expect to see that large fiscal stimulus continue to increase consumption and that the central banks will not be able to rein in inflation expectations. Therefore, bond yields are expected to persist with the continued recovery. Based on analysis on the 2 to 10-year Treasury bond spread, a rate hike is unlikely to appear anytime this year, and it has not reached 280 bips on the upper bound that preceded previous rate hikes. Rate cut cycles have historically lasted 3 to 5 years. Having only cut rates for a year, the Fed is unlikely to announce a tapering soon, as we believe that higher yields are now relatively safer and provides a bulwark against rising yields. We propose to overweight on high yield and EM bonds while underweighting investment grade bonds. Low yields indicate a meager fixed income return, and rising yields cause capital losses. We foresee risk-on sentiments to create a rotation out of traditional counter-cyclical bonds. Therefore, we propose to overweight on equities and underweight on bonds.
Here's a list of funds that will make up our portfolio, which is diversified across not only the asset classes, but also a range of countries. On the right side of the table, we can see that as our SAA said earlier, as well as how we adjusted the weights for our tactical asset allocation, or TAA for short. These adjustments were made based on our views on the global macroeconomy. We have a shift of 6% of our allocation in bonds into equities and alternatives, creating a 32 by 44 by 24 portfolio. Because we remain bullish on high yield bonds, we decided to take this 6% out of the government and EM bonds that we are predicting will underperform. Lastly, within equities, we are shifting the weights away from US and into Japan and China. This is to capitalize on the strong economic recovery outside the US.
Our recommended portfolio has also been back-tested using Excel and historical price performance of the various funds. The result shows that the return has outperformed the benchmark over the last 5 years. We also have stress tested this portfolio to see how it has performed through some of the economic crises of the last 5 years, and it experienced maximum drawdown of only 11.7%. This has demonstrated the optimal portfolio's ability to weather through storms of the financial markets. With that, we come to the end of our presentation. Thank you for listening.
Okay, so thank you, our students from NTU, for sharing your work and your efforts, and also your views on the investment situation across the world currently. Right? You can see that a considerable amount of work was put into coming up with what you guys have, right? And you guys have definitely learned a thing or two from AllQuant, right? Especially in the area of back testing that we saw, right? And also in that work that you guys just put up, right, you can definitely see that appreciation of diversification that we have, right? And that is definitely far better than what we really see, which might constitute just a number of stock companies or just a number of different highly correlated funds. Right? And we will need to move into the general Q&A section for today's multi-strategy topic soon, right? But before that, let's quickly just have a few comments, right, from AllQuant, Ling and Patrick. Maybe you guys would like to have a few comments, share with our guys over here about how they have done, right? And if you guys would like to ask them any questions, now is the time as well.
Okay, Dawi, let me go first. Okay, okay, first, what I like about it is a very visually appealing presentation, and I think it's professionally done. So I think I like the way that you all kind of like adopt a very systematic and logical top-down process where you start with your like strategic asset allocation. Then after that, you move on to talk about your own like market outlook and views in terms of like the economy, the business cycles, and you mentioned the pandemic and what you think will be evolving right within the interest rate environments. Then based on your views, then you use that right to move into your tactical asset allocation part where you kind of like changes the allocation to the different asset classes. Okay, the flow is very good, I would say, and it is almost like you're already like professionally running a fund yourself. Okay, and based on the past student sessions that I have with you guys, I know that most of you are only experienced with stocks, and then you are focused mostly on the qualitative aspects of analysis. Okay, but This round inside your work, I see that you're kind of already used a blend of both qualitative analysis and quantitative approach, combining out all of them together. And you also move out of stocks and look into other asset classes, and that is really good as well, because I know it is not easy to do so, right? To move out of your comfort zone, especially in such a short span of time. Okay, so good effort, I would say, right? And some suggestions on maybe the presentations. So for example, when you show the first slide within the strategic asset allocation, where you show performance statistics, maybe you can already at that point in time, like define upfront what is the time period that you were like specifically looking at, right? When you came up with all those performance set of data, because I only see it at the end towards the backtest slide where I think you show the time period when you show the NAV chart. Okay, and when you show the backtest slide at the very last slide, right, I think it would be good to have a table also summarizing the performance stats, showing the annual return, the risk level, the volatility, as well as things like maybe the maximum drawdown to give people a more straightforward view of how much they will actually get, right, in terms of investing into the particular fund itself. Okay, and one thing is that since you're also positioning your portfolio, right, according to your market outlook, which you use to kind of make changes to all those allocations, then when you have an outlook, it's also important to say have a time frame. Okay, so because I mean, that outlook won't stay forever, right? So you got to kind of mention to the people or tell people that no, this outlook for the next 6 months, the next 1 year, the next 3 years, so that people can have a time frame to see how long, right, do you expect this view to actually last. All right. So for example, last time when I'm talking to hedge fund managers, typically the questions that we pose to them is they tell us that they have these views about the ongoing market. So the next thing that we always ask is what is the time frame that you're looking at for this view to actually pan out, to actually appear? And then the next thing is, what are the catalysts, right? Do you that make this view of yours, right, going to happen within the time frame that you set? So these are kind of questions that people will typically ask when you have like market views in place, right? Then the next thing will be, it will also be good maybe to kind of point out like what are the possible risks involved with respect to the view that you're presenting. For example, the view is, of course, is a view and it may not materialize. And what are the possible risks in place that that can affect or derail your views from happening? Okay, so for example, I see like overweighting towards emerging markets, or be it inside, be it equities or bonds. So you can consider like, okay, what would happen in a crisis when that happens, or what will kind of potentially strike emerging markets, for example, right? And last point maybe is it would be good if we can see a longer backtest period, but I know that it is often constrained by whatever data they can reach out to. But it would be definitely good, right, to see kind of like a portfolio or your fund being backtested against, say, the great financial crisis, for example, or even stretching as far back to the dot-com crisis, so that we can see how resilient the overall portfolio is when they really meet a serious crisis that comes along. Okay, so that's on a whole my comments about it, but I think it's really, really great work that you guys come up with. It is only a short few weeks, right? And you only have like 2 sessions together. So I think that was fantastic work done. Okay, well done, guys. Okay, so Patrick, you want to chip in and say anything?
I don't really have much to add besides what Ing have already said. But yes, overall, I think it's a very good effort from you guys. Maybe just to give you guys some chance to clarify, just not very clear maybe on the optimization part of your portfolio. Can you maybe elaborate a little bit about what exactly is it that you guys are optimizing the portfolio for? That means, what is the goal? What is the goal of the optimization process? Okay, that's one. And then the second one is that once you arrive at the so-called optimal weight, right, of the allocation in your portfolio, is it meant to be static, meaning to say that the allocations are fixed in place, or do you have some kind of process whereby you can actually adjust the allocation along the way? So maybe you guys can clarify a little bit more on this point.
Okay, yeah, thanks so much, Ing for your comments as well as for your question. So with regards to what we actually seek to obtain the portfolio, right? Actually what we do is, because from the database that we obtain, which is provided by JP Morgan every year, they will give us the correlation of the asset, how the different asset classes interact with one another, and the amount of information that they have, the specificity of their information is really quite in-depth. So, but because it's correlation, so what we do first was to convert the correlation of the different asset classes into the covariance. So after we found the so-called covariance of how the two asset classes interact with one another, then what we do is to calculate the portfolio variance. So the mean is obtained based on the historical prices, how the price of the different funds have moved over the past few years. So once we got the variance and the mean, right, what we seek is actually for the highest Sharpe ratio. So we use the Excel solver, and then we put the goal to maximize the Sharpe ratio. But of course, like what Ingwan and Patrick, you all mentioned earlier that bond actually gives the higher risk-adjusted returns. We saw the same when we were doing the Excel solver. So actually, when we do the Excel solver, US municipal bonds were actually they recommended 100% in US municipal bonds. I think because they have the higher Sharpe ratio. So then we have to put a cap on a 20% cap on how much each asset class can have in maximum in our portfolio. And with that cap, plus a couple of other limitations, that's how we eventually end up with the optimal portfolio that we have presented. As for the second question for Patrick, whether how we change the weightage of the asset classes over the next few months based on the movement of the market, we currently do not have any strategies put in place, but that is something that we will consider moving forward. Yeah. So thank you so much, Patrick, for the comment.
Okay, thanks for elaborating and clarifying on this part, Jinwei. So yes, I think you're basically on the right path in terms of building a resilient portfolio. So like you mentioned, right, one of the things that maybe you guys can work on going forward is to look at how you can make this a more dynamic kind of allocation process, because obviously the window that you have used to work out all this portfolio weightage, right, is based on some fixed historical period. So as time moves on, right, then you have new data coming in because it's a moving window, right? So then your question is whether do you still want to use the same approach that you have done to recalculate the new weights and then rebalance your portfolio to this new weights? So is this the most optimal approach? Because what you have described seems to me like it's more like trying to find out basically the tangent portfolio, right, which is the super efficient portfolio that I've shared earlier in my presentation. So is the super efficient portfolio maybe the really most the best way of allocating a portfolio, or is there perhaps another better approach, like maybe risk parity, the all-weather allocation approach that Ingwan have shared before? Okay, so this is perhaps something that you want to think about going forward. Yeah, thanks.
All right, thank you.
Okay, so thank you for that great sharing and the back and forth question and answers, right? It is so good to be able to see our young people being this keen, this open, humble to come and hear and learn about investing, and so that they can keep improving themselves over time, right? And so that's all for today's student challenge, right? Next week, we are going to have students from our SUSS, right, investment club, to come and share on their proposal and their ideas. Okay, but for now, right, thank you to our students from NTU Investment Interactive Club. Right. And for now, we do need to go into our general Q&A for the multi-strategy portfolio. Okay, so if anyone has any questions on what the multi-strategy portfolio is about, right? How is it run? Right? How do we go about implementing it? And is there any concerns or any possible shortfalls? Please feel free to type your questions in the Zoom Q&A section below. Okay. Okay, so we are seeing a question come in. Right, let me see what is being asked. Okay, so it's a question from our anonymous attendee. Right, is there any other benefit from the multi-strat approach besides diversification? Ingwan and Patrick, do you guys want to come and answer?
Okay, maybe I can take this question. So basically, other than the benefit of having, what I mentioned earlier about the team-based approach, right, whereby you have different strategy that performs well under different market conditions, working together so that you ensure that no matter what the market happens, right, whatever condition that you're in, there will always be strategies that are performing well for your portfolio, so that at the overall level, okay, your portfolio will be resilient, right? It will not go down. Maybe it will not go up drastically, but at least you save yourself from that drawdown, so that subsequently when the next favorable environment comes along, right, you don't have to start from the stage where you're trying to claw back your losses, but you can immediately start from where you are and continue to build on your portfolio to further gains. Okay, so other than that, the other benefit is, of course, the usual benefit you get from regular rebalancing. Okay, so let's say you have a multi-strategy portfolio, right? And then you have a regular rebalancing routine. So for example, you might maybe set yourself a rebalancing frequency of once every month, okay, or even once every half a year. But no matter what, right, at the point of rebalancing, you will always have strategies that are maybe underperforming compared to your other strategies. So what happened is that at a point in time, right, you can then allocate reallocate the capital from those strategies that have done well. So in a sense, you're like reaping the profit, right? You're basically reaping the profit and redeploying those profits into the strategy that is underperforming. So if you believe that your strategies are still working well, right, there should be this mean reverting behavior. Okay, so your underperforming strategies will subsequently start to outperform. Okay, so it is very opportune for you to reallocate capital from those strategies that are outperforming. Okay, cut down those sizes, reallocate to the underperforming strategy, so that subsequently going forward, the roles can reverse, right? And then this reallocation actually helps to add returns to your portfolio as well. Okay, so this is one other benefit that I've not mentioned so much in my presentation just now. Okay, but I think it's a very important benefit also. Okay.
Okay, thanks, Patrick. Let's move on to the second question. We do see another question from another anonymous attendee who is asking, other than the volatility strategy, what other assets can be used in the multi-strategy approach to minimize the risk?
Okay, maybe I'll take this question. Well, again, I think earlier on we did show the multi-strategy portfolio performance, as well as I think Patrick talked about it a little bit earlier on, that we actually run multiple different strategies, and those are actually spread out across many different asset classes. So of course, the volatility strategy will be running basically the volatility asset class, which will make use of the ETFs to do it. But there are also like other strategies, like the all-weather strategy, which also inside there. We also be running things like your sector strategies. So you're going to have various different types of ETFs across asset classes like equities, bonds, commodities, as well as even like real estate. Right? So a whole spread of all these different asset classes, right, can actually help you to kind of lower down the overall risk of your portfolio, right? So okay, but the most important thing is, besides the different asset classes, are the strategies that's at work, which I think Patrick has presented early on, right? Because of different strategies, you can actually push the boundaries even further. You can shift your entire efficient frontier further up, right? So that you're no longer bounded by the constraints of what you can do, right, with the present asset classes that you have, right? So it goes beyond just allocating the different asset classes. But now we've moved one step level up to go and look at the different strategies. Okay, yeah.
Okay, thanks, Ingwan. Right. Let's move on to the next question. There's a question from Kelvin, who's asking that given the dynamism of the multi-strategies, how do we keep the cost low to reasonable levels? And also, is it okay to show your NAV net transaction cost to get a better comparison on net return after cost? Patrick, you want
okay, maybe I can take this one. Okay, so Yes, multi-strategy obviously has a lot more balls that you need to juggle, right? So the thing is that there will always be certain strategies that are perhaps more, higher trading frequency, and then there'll be certain strategies that are less frequent in terms of the trades that you need to do. Okay, so obviously, if you want to run a multi-strategy approach, right, just think about it. Each strategy itself has its own portfolio of holdings that you need to hold and you need to trade. So if you think about it, you will probably need a certain minimum size of AUM before you can run a multi-strategy approach, right? So if you have a large enough AUM, right, I would say that because you're transacting very small trades every time there is a signal that comes along, so it won't be the entire portfolio that you need to trade, but really just that slice of the strategy, and within that slice, right, it's just a single security that you need to trade. Okay, so it's actually a very small part of the entire portfolio that you're trading, and because of that, right, the cost is actually very, very minimal. Okay, and also as I mentioned before, right, there are other strategies that are less transactional in nature. So it's not true that if you run a multi-strategy approach, the cost will be very, very high, right? So in fact, the one that we are, or rather iFAST is helping to implement, right, the multi-strategy portfolio, in terms of the transactional volume, it's actually quite low. In fact, most of the time, we only have transaction like maybe once every month, and that's only because there's the need to rebalance. Otherwise, on intra-month basis, we don't really have much trades on and off. Yeah. Okay, as for the second question, right, whether can we show the net transaction cost to get a better comparison? In fact, that's what we have already done. Okay, so all the performance that we have shown in our presentation so far have already taken out the transaction cost. So it's actually on a net basis. So what you see, right, is really what is the returns that you will get net of all these fees, all these transaction costs already. All right, yeah, that's all.
Thanks, Patrick. And also let me just come in and mention something a little bit on top of this. Right, so in the practical sense, we also have cases whereby clients are hoping to top up their investments in the middle of each month, right? So within the month, we also look at things like whether that topping up, is it sizable enough, and is it really worth the individual ETF transaction cost, right? Because if it's not that efficient in terms of the cost, we will always recommend you guys to actually just do it when we are commencing the next rebalancing that we do every month as well. Okay, and also for individual cost wise, we do take those into consideration, and actually AllQuant has been running not one but two possible portfolios whereby one of them are a little bit larger size and the other one is a little bit smaller, so that we actually still keep that individual ETF allocations efficient in terms of cost. Okay, so let's move on to the next question. Right, we do have another one. Let me just bring it up. Okay, so this is asking that stocks are giving good returns, and it is safe for us to, if it's safe for us to hold it long term despite all the ups and downs. How is your approach, and how is your approach any better?
Okay, I can answer this. I think I addressed this kind of like in the first few webinars when I started talking about risk. Okay, so the thing is, okay, if you look at stocks, I think it's quite pervasive now because it's being shown everywhere. People talking about stocks, telling you that investing in stocks for the long term is safe. Okay, for example, I tell you that stocks between 1970 to 2020, they can return you 9%. Okay, so I think most of you out there is going to assume that you can just get that 9% if you hold stocks long enough. So say I hold it for 20 years, I can get 9%. But is that really the case, right? So I think I showed in one of those earlier webinars that no, that's not the case, no. So yes, the stocks have over that 50-year period on average delivered about 9% per year. Okay, but if you were to invest your stock, right, in any of those years and then start holding it, let's say for 20 years, your outcome is very different. No, it may not be 9%. It can be as low as only 3% per year after you hold it for 20 years. Or it can be as high as 15 or 16%, depending on which year you start, right? And here we're talking about like a 20 or 30-year investment window here. And there isn't a lot of scope for us to kind of shift that window around. You can start a few more years later or a few more years earlier, but no, that's the max that you can play with when you're talking about such a long time window, right? And we can't really kind of dictate which year we're actually born in or which kind of market cycles that we're going to experience throughout our lifetimes. So there isn't a lot of scope that you can actually play around with. Then you do just a simple buy and hold and hope that you really get the 9 or 10%, which you see that has happened historically in the past. So this is what we call uncertainty in your investment outcome, because it can range anywhere from 3% to 16% and not necessarily hit your 10% or 9% target there. So, I mean, if you end up on 15, 16%, I think everybody's going to be happy, right? It's a happy scenario, and we can all happily go back ever after, because you far exceed your target. But what if you end up with only 3%? So that means you hit only about 1/3 at the end, or after 20 years of what you wanted to achieve. So imagine you want $1 million to retire after 20 years, but now you're going to end up with only $300,000. So whatever plans that you're going to have is going to be torn to stress, basically at that point in time. So it is with this uncertainty in mind, which is why we want to manage risk. And that is why all this multi-strategy approaches come here. Because if you have a portfolio that can just steadily and stably increase and help you weather through different kinds of market conditions, then seriously, you don't have to kind of really be worried about uncertainty. Or at least you know more or less after 20 years, you have greater confidence and probability that you're going to land where you are. If I target for $1 million, I want to make sure as far as possible I hit that $1 million. Okay? So I don't want that kind of uncertainty. Yes, I can get 1.5, but what happened if my case, I end up with 300,000? Then that would be a serious case. Okay, and it's not like we're defenseless against it. So if you know and understand the concept of risk, you know how the financial markets work, and you can come up with like different strategies and diversify properly, right? You can hit your target there. Right? So that is the advantage of a multi-strat over a typical, let's say, buy and hold. Right? We don't live forever. Like, and we can live 100, 200 years, then okay, then maybe my approach is not that valid. All right. Okay, yeah, so that's all I have.
Yeah, maybe I can also add on. So in fact, one of the topics that I'm going to talk about in the next upcoming webinar, right, which is happening on this, or rather next coming Tuesday, is that you can actually create a passive income for yourself using this multi-strategy approach. And basically, one of the very important elements, right, if you want to do it this way, is that you need to make sure that whatever portfolio you use, that you base on to generate a passive income, must be resilient in any kinds of market condition, because you don't want to end up in a situation whereby, because you cannot time when you need the money, right? So can you imagine now, if let's say you're already retired, okay, back in before the great financial crisis happened, and you are, withdrawing maybe like, I don't know, 10% out of your portfolio every year for your expenses, right? And then all of a sudden, the great financial crisis hit, right? And then all your portfolio is basically held in stocks, and your portfolio lose 50%. So now your portfolio is only worth half of what it used to be worth previously. So now if you continue to draw the same amount in terms of dollar terms from your portfolio, right, you would actually be drawing out 20% and not 10% from your portfolio. And you can imagine if you keep drawing out 20% from the portfolio, how is your portfolio able to recover to be able to sustain your passive income going forward? Right. So drawdown is something that is very critical, and people need to bear in mind, because they always think that, oh, drawdown can recover. But yes, it will recover. But the problem is that we cannot time our lifespan, right? Because it really is when you need the money, you need money. You cannot say that, oh, I want to wait for 1 year or 2 years down the road before I take the money. You can't, right? So in fact, there is this mathematics of drawdown, whereby if let's say you lose 50% of your portfolio value, right, you actually need to generate 100%. Okay, that means you need to double whatever remaining behind your portfolio. You need to double that before you can actually make back whatever you used to have. So the more you lose in terms of drawdown, right, the harder it is for you to claw back to even. Okay, so this is something that is very important. Okay, I'll talk more about this in the upcoming webinar.
Thanks, Ling and Patrick. Let me just quickly add something on top of all these as well. Right, in the practical sense, right, when we are running client advisory on investments, right, we do see cases whereby people are getting their bonuses, big bonus, big promotions, or maybe just simply retiring, right? And it just so happens that the timing is right before a big financial crisis, right? And so if we are considering to top up, to invest more, right? A lot of times it is not so much what you buy, right? A lot of times it is just a matter of that timing, right? And many people have tried various ways to try to time the market, and it is simply not easy to do at all, right? For those of us who might be a little bit more senior, like maybe you are in your early 50s or mid 50s, right? And the truth is you are not very sure at all when you would be retiring, right? Because some people retire at 55, some retire at 60, 65, right? Some work all the way until 67, right? And the thing is, we don't know when that's going to happen, right? Maybe when it happens, it just happens right after a financial crisis, right? So a lot of times stability is what we are looking for, right? And this is where the multi-strategy portfolio can come in and be of very much value to us. Okay. So let's just have one last question since we are overrunning a little bit, right? Okay, so last question over here. Is it complicated to run the multi-strat approach on my own?
Okay, maybe I can try and answer this question. So like I mentioned before, right, if you want to run a multi-strategy approach on your own, then you need to know that you are basically managing a lot of different strategies within your portfolio. So obviously you need to know the strategies intimately, how it works, what are its return drivers, what are the risk factors. So if you have developed yourself to the level of knowledge, right, whereby you can safely say that, oh, I know this strategy inside out, I know what are the pitfalls, so I can watch out for those pitfalls, then yes, in terms of running the multi-strategy approach, it is not too difficult. But again, maybe it's a bit more time-consuming because you're juggling a lot more balls. So you need, every time it comes to the month end, right, and then you need to do the rebalancing process, you're basically rebalancing across many strategies, right? So you need to go to each strategy and calculate, oh, what are the things that I need to do? And then after that, you need to zoom out and look at the overall portfolio level, how I need to rebalance among all these different strategies to make sure all my allocation is still correct and accurate. All right, so this is one aspect in terms of operational features. So of course, the other thing is that, so you need to handle things like, in case, right, if one of my strategies seems to be deviating from what I've previously seen based on the backtest, right, how should I go about adjusting my this strategy, or should I actually take it out totally from the portfolio? So this requires a bit of a value judgment. So this comes back to the point where you need to be very confident and know what this strategy is trying to do. And then you need to look at a qualitative aspect to see whether are the fundamental assumptions behind this model still valid. Okay, so these are the kind of judgment that you need, and it comes with experience of running the models. Yeah. So operationally, no, yes, you can do it yourself if you want to, but it's just that you need to be aware that there's a certain level of expertise and knowledge required behind it.
Okay, thank you, Patrick. Right. So we are running for a little bit, right? So let's pretty much close the session for today. And for the next coming week, in our final week of the festival, we are going to talk about a topic that a lot of us would be very keen on having, right? And especially when we are approaching a little towards retirement, right? How do we generate perpetual or recurrent income for ourselves, right? And throughout the investment world, there are different ways to do it, and one of which is to do it through quantitative investing and through a stable portfolio approach, right? So coming Tuesday, we are going to share on this, right, with Patrick coming in to help us with it. Right, so for those of us who have registered only for this session, or maybe you have not registered for the next session on Tuesday, please do remember to sign up, right? And we look forward to seeing you there very soon. Okay, so that's all for today. Thank you for coming, and we definitely are very appreciative, and thank you for really being with us here today. Right, look forward to seeing you guys soon. Okay, that's all. Thank you, and bye-bye. Have a great weekend.